Hi, I'm Jessica Irving Marschall, President and CEO of Moss LLC, and today I'm going to be talking through questions that we are receiving a lot about S corporations, the S election, and some of the hot button issues that we see that will be in this presentation. Okay, so this is a client's guide to S corporations, and we're trying to cover some of the more hot button issues that are often missed, especially beyond just the basics with S corporations and the S election. So an S corporation is a federal tax election. It is not a state law entity type. An eligible corporation or LLC that elects corporate taxation elects S status with the IRS. There's a check the box that this can be done after entity is organized on Form 8832, or there is Form 2553, which can be faxed in for making that election from an existing entity. So corporate legal structure pass-through taxation, meaning it is still passing through onto your individual 1040, just like you would with a single member LLC or multi. It is not a standalone taxable entity like a C Corp, and there is a mandatory payroll treatment for owners if it is profitable under Section 1366. Shareholders, not partners, and they all receive K-1s, much like they would with a partnership, and the tax form that is filed for an S Corp is an 1120S. Okay, why do you choose S Corp status? Number one, pass-through taxation. Like I said, this is passing through, drilling down to your 1040, so it is going to be taxed at the marginal and effective tax rate of you as an individual. There is real separation. There's separate accounts, payroll, contracts in the company name. It's a cleaner path to roll up into a sale or mergers. And the payroll tax planning is for W-2 wages for owners' work and distributions of remaining profit that generally can escape self-employment tax. This is the number one reason that most people in our experience make the S election, is to dodge some of that 15.3% payroll taxes that aggregate on page 2 of the 1040 under other taxes and tend to freak Schedule C owners out when they see it. Owner benefit planning, better choices, retirement, accountable plans, health insurance. We get into some of those special elections, special rules for that as well. So it's usually a good fit if the company is profitable. I usually, for a single member LLC, once you're looking at net income of around 50 grand, it starts to make sense with the extra cost of the tax return preparation, the maintaining of the accounting records, as well as running the W-2 through payroll, which is actually done through payroll. It needs to be done through a payroll service. It's typically not a DIY. You need clean books, payroll, ownership records, basis calculation, and very important, do not plan on holding appreciated real estate inside an S election, which we'll get to. And then the owners need to understand that distributions are not unlimited. It's not like a Schedule C, which essentially can be treated like a piggy bank. You take the money out when you want it, put the money back in. That's a balance sheet transaction. You don't need to have BOD meetings and have an official shareholder distribution. So market-based, reasonable salary to the owner. It needs to be this, the IRS calls it reasonable compensation, which is, it's an amorphous term, and we need to use our best knowledge as CPAs. We want it to be as low as possible, because the remaining delta that's not paid through that W-2 passes through to the Schedule E, devoid of the self-employment tax of 15.3.4. If you think about the W-2, you're paying full self-employment taxes because you're both the owner and the employee. So you're paying both parts of the Medicare and Social Security. Look at the payroll taxes, processing costs. Again, if you're a small company, just sign up with a payroll company that, and I can give you some recommendations offline, and separate bookkeeping and tax return prep. Our firm does the tax returns on that, and then really make sure you have a good bookkeeper in there. Again, I have great recommendations for bookkeepers that we trust. Distributable profit still left after all of the above. If you're barely breaking even, then the numbers won't work out. And we usually do a quick analysis and we send the clients, here's how much you could save. And then once it's 4,000, 5,000, 6,000, then it starts making sense. Wages first, distributions second. So this is what's critical. Officers are employees. So under Section 3121D, officers who perform more than minor services are paid as employees with a W-2, again, with payroll. So have that payroll service filing those 941s, 940s, and the state equivalent if applicable in your state. Again, outsource this because payroll companies do this much more affordably. Our firm does not offer payroll services because it's not cost effective for clients. You would not want to pay a CPA to, in my opinion, to be doing payroll. Calling a payment a draw, distribution, loan, or dividend does not change what it is. The IRS and tax court is really digging into the underlying economic substance of transactions. So just because you go in there and you claim that that distribution is a loan to avoid tax on excess contributions in excess of basis, that doesn't mean that's what it is. So the IRS looks for the gap where they're looking for large distributions. Let's say that somebody is running a law firm and they give themselves a salary of $35,000 and then they pass through $500,000 in distributions. I can say it doesn't pass the sniff test. We look more at how many hours are you working? Do you have other jobs? Maybe that reasonable salary is $150,000 and that the excess can be passed through. It all depends on the facts and circumstances, and it depends on me writing up and defending or your CPA a reasonable compensation. But that is the first thing their IRS looks at. And just a friendly reminder, you screw any of this up, they revoke the S election and you can't get it back for 5 years. So it's super important. What mistakes cost? This is a tax court case, David E. Watson v. US. CPA shareholder paid himself a modest salary, taking large distributions. Eighth Circuit upheld the IRS, recharacterizing part of those distributions as wages, weighing qualifications, experience, hours, etc. And again, when they go back and recharacterize this, it's not just for that year going forward. It's for years in the past, which requires more amended returns, underpayment penalties, potentially interest, fines, penalties. It gets expensive quickly. If distributions become wages, then you have the FICA, you have the unemployment taxes, income tax withholding. Like I said, failure to file, failure to deposit, accuracy related, interest compounding. I sat in on an audit as advisory on this, and I saw an S Corp end up with well over $200,000 in fines and fees just to get themselves through the audit. And again, it could have been avoided with annual reasonable compensation, duties, hours, comparable wages. Document the heck out of it. That's always the best thing to do with the IRS. Distributions are not automatically tax-free. That's another thing that people don't understand. You've got to have skin in the game. Skin in the game is your stock basis, meaning you put some money into this company. That stock basis increases with net income, decreases with net losses. Cash investments are shareholder investment. That increases your basis. When you take the money out, it decreases. So Section 1368B, a distribution beyond adjusted stock basis is treated as a gain from selling the stock. It triggers capital gains and is a fun little surprise for your regular 1040 CPA where your K1 is populated the Schedule D, and usually it results in calls to CPAs like me where they say, where is this coming from? And then I walk them through basis. This shows the ins and outs of stock basis. Essentially, you're showing that you have skin in the game. Two basis traps owners miss. If you claim an S Corp, the Form 7203, first of all, stock basis is not optional. We see so many returns that come through where people have chosen just not to calculate basis. It must be calculated. It's a limitation on the 1040 as well as on the 1120S. Disposing, if you receive a non-dividend distribution, dispose of S corporation stock, receive repayment of a shareholder loan, maintain it every year, calculate it, make sure it ties to your books. If you're an S Corp, you must be using accounting software, whether you're using a web-based QuickBooks or you have a accounting software system in place. It's a must. It's not a spreadsheet type of company. There is corporate debt that is not on the basis. Bank loans, SBA loans, credit lines, and equipment notes create no shareholder basis. So if you take out a $500,000 loan from the SBA, for example, and then distribute $300,000 of it to the shareholder, for living expenses, for whatever that is, if there's not $300,000 to absorb that distribution, you've created a capital gain in excess of basis. Only bona fide debt owed directly to the shareholder creates debt basis. And even then, the debt basis supports loss deductions only. These are distributions are measured against stock basis. This is the Schedule M2, which is just so much fun. And I say that with a lot of sarcasm. So we have the AAA Accumulated Adjustments Account. This tracks previously taxed income not yet distributed, up for taxable income, down for losses, non-deductibles, and distributions. It's not shareholder basis. A shareholder can have basis when accumulated adjustments are zero. OAA is another adjustments account. This tracks items that affect basis but not AAA, notably tax-exempt income such as certain forgiven relief funds. Same dollars can never be used twice to support distributions. And then the M2, it needs to be reconciled. It should never be plugged. We see so many times where this is just plugged. If the books, Schedule L, AAA, OAA, and basis disagree, find the reason. Book to tax differences, unposted adjustments, misclassified loans, bad opening balance. A forced plug grows every year and creates a situation where you need to spend potentially tens of thousands of dollars to go back and dig through and refile. And then keep in mind that if you refile for 90 shareholders, they also must refile their 1040s. And usually if you're going through this exercise, it's not in the taxpayer's favor. So you'll have a lot of shareholders who are quite ticked off with you if you did not handle this correctly in the beginning. Here's a cleanup story that shows, this is just fictional, but this is what we see as the emergency clients that come in. And this just walks through what would happen. The book and return don't reconcile. So there's an M2 ending balance. Prior year adjustments are unclear. Draws continue despite negative equity. And so then the accountant decides it's a fun idea to reclassify the distribution as a shareholder loan. Corporate debt is treated as basis support. And then you see the return that's not yet filed for the current year, and they propose moving the draws to a loan receivable. The IRS sees through all of this. They're trained to do that, and they will just punch a hole in this. And again, the really scary expenses for the CPA, potentially tax attorney, as well as the underpayment penalties. And really, most importantly, you and the entity are then on the IRS's radar, as are all of those K-1 recipient shareholders with their social. So again, I just can't emphasize enough, do this correctly from the beginning. Negative equity was the warning here. Steady draws when there was no equity means that you're taking money out that was not, you didn't have the skin in the game. The corporate loan gave no basis. Entity level debt never became stock basis or debt basis. It could not support a single tax-free dollar. OAA was spent twice. Same tax-exempt dollars absorbed distributions in 2 different years. M2 error compounded. It got worse as they went. Excess draws were capital gains. So with a client like this, you need to go back under Section 1368B, redo the returns as far back as you're allowed to amend. The loan story that came too late. If there was a loan at the beginning and you really want to have a legitimate loan, there's AFR rates with the IRS. You need to have that arm's length, and you need to document that. Like I said, the IRS is looking for a reasonable narrative where the economic substance matches the facts. And there's a huge tax code with 76,000 plus pages that they have on their side. The fix is never another plug. If sometimes accountants get in over their head, they're just not they're not experienced doing the 1120S's in the basis, that's where you reach out. Firms like us, who are old, hardened 50-year-old CPAs, we've seen a lot. And our firms do things like cleaning these up, as well as helping CPAs to learn this. Because, I learned this back in grad school in the early 2000s. And this is what we specialize in. There are other parts of the tax code where I am clueless, and I would be referring my client to CPAs who specialize in that. So we can't all be experts of every part of the code. We need to pick our lanes, stay in them, realize when we're out of our lane, and unless we want to do the due diligence of getting the continuing education and compliance, this is where CPA networks become very important, bookkeeper networks working together. Health insurance, very important. There is a way for the health insurance to be directly deducted on the 1120S as a business expense. Note that W-2 reporting, so you're taxed for income tax withholding. You are not taxed for FICA or for the unemployment. The payroll company needs to know how to do this. Most do, but I still am shocked when I have to have this conversation once every few months with payroll providers to make sure that they're withholding correctly. So earned income is tied to Medicare wages from the Corp. Insurance in box 1 with no real wages can mean no deduction. Notice 2015-17 still protects owner-only reimbursement arrangements, but including non-owner employees can create ACA exposure. Again, I have some great references for people who run health insurance and who run the benefit plans. I know the tax aspects of this and what it needs to look like. We rely on the experts to make sure this is set up correctly. And again, I can provide any of those referrals. Real estate rarely belongs inside the S Corp. 600 grand taxable gain, not a dollar of cash received. A building with 300 grand basis, 900 grand value is distributed to the owner. Under Section 311B, the corporation is treating as selling it at FMV. The gain passes through. This is why real estate is held in partnerships or in standalone LLC holding companies, HOCOs, because you do not want to distribute out to FMV from an S Corp. It leads to all sorts of terrible built-in gains that is in there under Section 1374. Again, just when in doubt, reach out to your CPA. It's very easy to set up with your corporate counsel an additional entity to hold that real estate. Shareholder loans, here's what needs to be in there for the example I gave before where they wanted to reclassify distributions. The shareholder lends to the corporation. This can actually happen if there's bona fide debt. Look at the checklist below. Corporation lends to the shareholder. It needs to be real debt from day one or it risks recharacterization as a distribution. Look at the IRS has AFR schedules. That needs to be about the minimum amount that you charge on these closely related debt. Maturity date, intent to repay, repayment schedule, written notes, stated interest, authorization, actual repayments. You actually have to repay the loan for it to be a real loan. Interest income booked. Keep in mind that interest income is taxable. So if you are lending and you are receiving interest, make sure that the company at year end does the 1099 INT and pay tax on the interest. Again, it just needs to be legitimate. 4 gates before a loss is deductible. Basis. At risk, keep in mind corporate debt and guarantees do not raise the at-risk amount. Passive activity, no material participation, no current deduction. Rentals nearly always need this analysis because by definition they're passive unless you are a real estate professional. Different webinar, you can look at that separately. Excess business losses under 461L caps the total business losses, and recent legislation made the limit permanent. A loss reduces taxable income only after it clears every gate. You confirm all 4, then you check the state rules. Because just to make it fun, every state may have different rules and different fixed date conformity. Run it right all year, not just in December. Separate everything. You need to have all of those assets tied to the EIN of the entity. Use an accountable plan. Document. Run real payroll. Contract with whatever payroll company you want and double and triple check that they are filing those payroll reports. Keep in mind that those payroll withdrawals are assets held in trust. So you do not play around with withholding from an employee's paycheck and not turning it right over to the taxing authority. Those are assets in trust. It is a felony, and it also pierces the corporate veil if you mess around with sales tax or payroll taxes that aren't just turned over. Check basis before draws. Paper the loans the same day they happen. Document it when the money moves, not when the tax return is ready to be filed and you just realize you triggered 100 grand in cap gain. Reconcile after filing. True up the books to match the return. M2 retained earnings and the basis schedule. This is where S Corps go wrong. Number 1 is payroll. Like I said, it's just make sure you are paying through a payroll provider. Distributions, make sure that you are capturing Form 7203. Loans, draw up all of the loans, make sure that they are accurately papered, documented, upload them with QuickBooks, save them in your permanent tax schedule. Personal bookkeeping, make sure you have a good bookkeeper. And like I said, I have a list of fantastic accountants that we refer others to. We have in-house about 25 on our team that can do bookkeeping, but I need to save them for more of emergencies. So we offer bookkeeping on a very limited basis. Appreciated real estate with no exit plan. Be careful, don't put that in the S Corp. Check with your corporate legal first at a new entity. Wages for, okay, here's all the takeaways. You can review this. This is everything that I just said. I won't go through this because you're probably ready to press pause on this presentation and think this woman is crazy that she enjoys this. I do. It's very exciting. If you need any help with your S Corp review, we work very well with existing CPAs because we are so grateful that they are out there, because most of us appear to be retiring or dying. And we have limited scope for being able to accept new clients, but we also, if your company isn't a good fit for our company, we have worked closely with other accountants who are accepting more clients, and we work great on a team basis with them. Reach out to us. All of my information is there. Thank you for suffering through this. I love this. It's very exciting. And if you have children going into college, I don't see AI taking over this industry anytime soon. I wish it would. I could then retire and just put my feet up. But unfortunately, the complexity of this will be working until the day I die and retire, which is at age 95, 45 years. Okay, have a wonderful day. Thanks for watching.